So let's look at why Broadcom might be so expensive. We'll just do the math. We take the price of the shares, $221. We take the trailing 12 months earnings per share, $1.22. We get a PE ratio of 181. So it's roughly in line with what stock analysis is showing us. The reason this is so high, because there was a one-off quarter of losses. You can see the data taken from the right. I think that's from Guru Focus. So it's always important when you're looking at this stuff to cross-check your numbers and data against different vendors, because oftentimes there are a lot of mistakes in the data. So we have that one quarter of losses that's bringing down this number, but then we have very high growth expected for next year. Well, how high? Well, you can go to Yahoo Finance and pull up these interesting tables that will show you what analysts are forecasting. You actually get the low estimate, high estimate, and average estimate, so we can calculate what's called a forward price to earnings ratio. This is taking into account the growth that analysts expect for next year. So take that price of $221, we divide it by the average forecasted earnings per share next year of $6.35. So significantly higher. We get a forward price to earnings ratio of 35. So much more in line with the benchmarks that we've been looking at.